All as well as we move through June here, getting very close to the summer and the kids starting their holidays. And the weather, of course, nicer, which is great to see. Markets have been on a rally since March, 9 weeks in a row, ended last week with the negativity we saw on Friday. But more negativity in the markets this week as well. So wanted to kind of touch base, show you what historically it's meant to have a rally like we've seen. So the last 2 months, the S&P 500 in the US up over 19% before this weakness that we've seen. So what does that mean going forward? And you can see a lot of green on the screen there. Looking forward, whether it's short term, 1 month, 3 months, or longer in the 6-12 month range, 100% of the time, historically, we've had positivity there. So we'll see what happens there. But you can see, looking out 12 months, the average rate, 41% return. Again, a small amount of data points there, but the average being a 9.3% and only up about 74% of the time. So it's kind of leading historically that although there may be some volatility day to day or week to week, has led to more positivity going forward in the future. And here's another way to look at that there. You've seen some of these go back to 1990 here, some of the signal dates there. And you can see that a lot of those have come off of negative points in the market. So drops in the market like we saw in March with a rally, but that continued rally there after the initial bounce back and that negativity. Again, here's another way to look at it. After a 9-week streak, which again ended last week, going back to 1950, where do we go after that? So you can see, looking out 4 weeks from that, almost always positive 90% of the time that positivity is continued. Whereas looking out a year later, 52 weeks, you can see that 80% of the time the markets have been higher, roughly average 9.8% return. So just because we've had this big rally doesn't mean that the markets now need to pull back a whole bunch and smooth out. It does tend to lead to more positivity. Although, like we've said and like we've seen in the last few days, there will be volatility as we do move forward. So why can the markets continue to move up? I spoke a little bit about this last week, but earnings growth just continues to move up and outpace the pace of the markets, actually. So we've seen from last year to the expected earnings of this year, 25% increase for those S&P 500 companies. So meaning those companies expect their earnings to grow at a faster pace than we're seeing the markets grow. So that leaves some room there for the markets to continue this rally as we move forward, especially as we get more earnings reports. And if those guidance from those corporations continues to grow, as well as if they're able to show that their guidance was correct and they're able to keep up with the expectations or surpass the expectations, leaves even more room for potential growth in the markets. Now, having said that, on the positive side, here's some investments, and this is before the weakness that we've seen the last few days, below the all-time high. So this isn't for the year, but this is below their last all-time high. So after the market weakness on Friday, we saw the S&P drop a fair bit coming off of that. You see Apple and Google and Amazon and NVIDIA there, some of the big tech names, those Mag 7 companies that we were talking about last year and a few years ago, especially a few years ago, with all the growth that we saw in those names, how they've drifted now from their all-time highs. Whereas you go down even further down the list and look at things like the cryptocurrencies of Bitcoin, Ethereum, and then, of course, some of the altcoins way at the bottom there, how negative that market's been. So risk off in that sense from some of those growthier names. Meanwhile, we've seen the market still relatively close to all-time highs. These are some of the drags that we've seen. Even gold and silver on there as that rally that we saw earlier in the year. And last year in gold, weakness there as well in its history. This is an interesting chart I thought I'd share with you. This is the overall dividend yield of the S&P 500. So this is affected, of course, by the dividends themselves, how much companies are paying out in dividends, but this is the yield, so also relative to the overall stock prices. So as the market rises, if dividends aren't being increased at that same rate, then obviously this yield continues to drop, and that's what we've seen. So markets continue to rise here over the last few years. That dividend yield is now back to under 1% overall. So if you were just to buy the total US market, you're only getting that 1% dividend. You can see in March 2009, when the markets were dropping, that dividend yield very high because corporations hadn't yet cut their dividends into the financial crisis. But you can see just how low dividend is. Some of that, I think, leads to the importance of paying dividends. A lot of companies are investing, especially those tech companies, investing the money as opposed to paying it back out to their shareholders, investing that money in future growth. So that's been one piece of it, developing that lower yield. And second, I think a lot of investors aren't really asking for that dividend anymore. You no longer need to have a dividend or interest income to pay your RIP payments or your monthly income, because the cost of creating that by just selling a unit or two is so low now that you don't really need to plan around that. So a couple things there I thought was interesting to look at how low that dividend yield's gotten. Unemployment rate in the US, we're talking about the economy here, it continues to drop here down to 7.2. You can see where it was about a year ago, up about 9%. So stronger economy than many people are thinking, which leads into that interest rate conversation. Interest rates, many were hoping would come down to continue to spark that growth. But with inflation higher and the economy and unemployment rates seemingly doing okay, there's less of a push to drop rates, and even starting to hear conversations around increasing rates into 2027. So that's something to keep an eye on there. Last but not least, not a lot here, but something to be a good reminder here, both on the upside and the downside when you're looking at the market. Have your plan, have a well-diversified portfolio. Do not make that emotional decision that you think we're at some sort of a peak, so you're going to get out, or a situation like this will happen. And at the same side, you think markets are starting to get weak. We see some volatility. I'm going to get out, wait for a better time to invest. As long as you're invested under your plan, you have your cash flow taken care of, and your risk levels are appropriate, your best move is to stay the course and wait out any of that volatility and any headlines you see, again, whether they're positive or negative. So that's it for this time. We'll be back in a couple of weeks with more charts. Look forward to connecting. If anybody wants to chat about their plans or about their investments, feel free to reach out with time. Thank you.